representing Franchise Secrets, Eric Von Horn.
Hey listeners, if you like this podcast and you want more content on all things franchising, then you'll love our free Facebook group. It's the largest and most helpful Facebook group in all of franchising. Join our free community of current franchisees and franchisors, plus future franchisees and franchisors at franchisesecrets.com/Facebook. Welcome to the Franchise Secrets Podcast. Your host, Eric Van Horn. Here today, we have a very special guest, my good friend and business partner, Mr. Scott Duncan. Say hi to everyone. No one's there, but you got to say hi to them.
Hello. Thanks, Eric. I'm excited. I don't know if I'm prepared, but I'm excited. So.
That's the best. When you bring on a guest that's not prepared, it's the best thing. Because literally, we were having a conversation about this when I was on my mountain bike or on the gravel grinder. He was in the home office. That he made sure that I knew he was working in the home office, and we were on a conference call with a franchisor and somebody that we've been wanting to be a business partner with for a while now, over a year, and we haven't found the right opportunity, the right business. We've looked at franchises and non-franchises to partner with this guy. And most recently, Scott and I have been investing in a lot of businesses that are very passive investments that are a promissory note and then equity kickers. And then we have friends like Justin Donald, and I have other friends that are doing passive investments into businesses, into franchisees, and it's a passive investment for them. And yet there's equity and cash flow and whatnot that goes back to the investor. So this is a different model than what I've talked about a lot in the past, which is the equity partner, operational partner, which Scott and I have done. But what we want to do is get into more of the passive investor role within the franchise model. So Scott, why don't we start out? Why don't you tell the audience just a bit of your background? Because I know you're a baller. Insurance, job insurance, does very well with that. Has set himself up with a great lifestyle, but also you have other things going on. So can you share a little bit about who is Scott Duncan?
Yeah, right. Okay. Thanks, Eric. So I've been in the insurance business for about the last almost 16 years. So that's kind of the way I built my career in employee benefits, all of those things, working with small and large companies. So that also gave me the freedom to look at some other business opportunities. About 5 or 6 years ago, I purchased a property management company that we do apartment complexes, really subsidized housing. Grew that company to where I would say 90% passive in that business, and so I've hired my key people for the different divisions, which are really maintenance, compliance, and then management. And so really it just is a matter of working with them on a day-to-day basis, a couple hours, maybe 4 or 5 hours a week, growing that business. And then, a couple years ago, got into franchising thanks to my good friend Eric Van Horn. So into some franchising businesses. We are partnering together. I also own another franchise business that my wife and I just recently purchased. And so we're kind of learning that business of being a little bit more passive, trying to be a little more hands-off, and I would say that that's a learning process for me. I'm used to being kind of hands-on and really trying to affect the business, so I'm really excited to get more into that passive role. So all over the place, franchising for the last couple of years, learning a lot, but just excited because I think it's a great opportunity with the right partners.
So he has franchise experience now. So he's got a bunch of business experience. He's in franchising now. As I've done podcasts on partnerships, whenever I talk about what a good partnership looks like, it's Scott and I. We have a good partnership. We've worked well together. We've known each other since we were kids, so whenever you've heard me talk about partnerships, great ones, it's with this guy right here, one of the great ones. And it's because we know each other, work well together, able to talk through difficult things on the front end, and we always have the partnership's best interest in mind. And so you always know you have a good partner when you're partnered in one business and you're ready to do it with the same partner in another business. That is a sign that you have a good partner. Let's pause there, because that's a question that you should be asking yourself. If you're in a partnership with somebody right now, would I want to start another business with this person? If the answer is yes, then that tells you that you have a good partner, even though everything may not be perfect and work out well or just to the way that you want it to all the time. So that's just a little side note. But Scott, as I was on my mountain bike, gravel grinder this morning, most of the time I'm mountain biking right now because it's summertime, but I was on an early morning gravel grind. We were on a conference call with a franchisor, and then we had this guy on, and we'll just call him Chris. And so we had Chris on, and we said, hey Chris, we know that we've looked at partnering with you as an operational partner before, but now we're thinking about just investing into this business that you own. We will be on the operating agreement. We will have a large chunk of equity. We will have a promissory note with the business that will get paid back at an accelerated rate, and we will provide a salary to you as the business owner. So think about it from the operating owner's perspective. They get a salary. They don't have to pay much. They're going to have some skin in the game. They're not going to have to pay much, and yet they're going to be able to have this business. And what I want in this partnership where we're the passive investors is someone that's proven. I don't want somebody that has not been successful with the thing that they've done in the past. I want a proven, successful person that may be in the corporate arena, that may be in the entrepreneurial arena already. But what do you think? He already has success as an entrepreneur.
Right. And I just on that note, I think in the past where I've made the mistakes is I've had a friend or somebody that I know that's good at something. We found a different business to partner on. Neither one of us really have the skills to run that business. Then that becomes a lot more labor intensive because now I have to learn the business along with them. So in this case, we're really trying to be careful and find that person who we can just let them run. They have the skills that can run this business better than I can, or that we can, hopefully. And so this particular person, we've taken a long time to find. He's got this particular set of skills that we think fit this business really well. And really the idea is being less active. I'm not sure I'm to the point where we can be 100% passive. I just don't know how that's possible in a small business yet. Hopefully I'll learn that eventually, but for the most part being passive, but then finding someone that we can send to training that can take the ball, take the ball and run with it, has dealt with employees before, knows how to hire, knows how to do all of those things. Instead of somebody young and new that maybe we've dealt with in the past, where we have to mentor them on how to even set up a business. Right?
I thought you were going to say, take the bull and run with it. You were trying to say something that was not right, and then you'd have been like me that always fumbles over his words or a saying at the wrong time. So not take the bull and run with it. Although I did go to a rodeo a while ago, and I brought my parents there because the girls love to watch the crazy rodeo because we're in the front row, and then the girls love to watch their grandparents, my mom and dad, freak out when the bulls come by and are like kicking up dirt and running up right up against you, inches away from you. So and the grandparents like to watch the girls get crazy and have fun. And so when you said take the bull, when you were going to say take the bull and run with it, I was going to say you don't want to do that's a bad idea. So anyway, but you had a good point there. If you as a passive investor are going to invest in an owner that is going to be the active owner, franchising is a great opportunity for this because the franchisor is the trainer. The franchisor is the support. The franchisor is doing a lot of this stuff. Can you do it in a non-franchise business? 100%. I've seen it done. We'll probably do it. We've looked at doing that, so we'll probably do that. But I would love to do that once that owner is a proven operator, meaning they've hired, they've fired, and where we've been able to see the whole process, where they've made good decision after good decision, and they've come to us for the things that are big decisions that they want guidance on, and then we'll provide that guidance to them. So I love franchising because it's an easy stepping stone for active owners with passive investors. Now, just for the record, we don't have experience doing this. This is something where I have mentors, I have friends, I have people that I go to and say, you've done this successfully. Let me know the playbook. What if we're thinking this, is this off? So this isn't me coming to tell you like I've helped a bunch of franchise buyers actually buy franchise. This isn't me telling you that I've worked with a bunch of franchises, helping them grow and scale their businesses and helping them find franchisees and develop franchise development processes, because I'm an expert in those areas, but this is a new area for me and this seems to have a lot of interest. So what we figured we would do is just give you a peek behind the scenes. This is probably not Scott's first or last time. It's your first time, but probably not your last time talking about this, because I think this is the way of the future for a lot of us that are wanting to be more passive investors. And a lot of our friends are wanting to be passive investors as well. So what's the big advantage for you to be a passive investor in a small business versus just putting more money into the stock market or things like that? Like, why would you want to invest in Chris to be able to own this business?
I guess I've just found I've done both, everything from real estate to some of the passive investments that you've talked about, Eric, where we can pretty much, I think we're pretty comfortable going out there and finding an investment where we can get double-digit returns with just completely passive, right? So when we look at a business, it's got to produce better than that. Well, in my experience, there's so many advantages to business ownership, and you know that. But from tax advantages to the fact that you can grow it to a lot bigger returns if you do it right. And so really, I like business. I like, even though I want to be more passive, I like being involved. I like seeing the marketing take shape, all of the sales aspects of it, and being able to, have my footprint or fingerprints on that a little bit. Another thing.
He likes to work with his feet a lot. He's a runner. No, he's not.
No, I'm not. But I really enjoy the business process. I do like franchising, because what I've learned since I've been in franchising is that I'm not sure I'm a business creator necessarily. I like the franchise model because I like to be able to take it and then maybe grow it. That's what I did with my my property management business, is took it and improved it and grew it. And so I like that. I don't know if I like starting from the ground up. So that's what I like about business. I think you can get a lot greater returns and a lot more benefits, but it's just really part of that balance of finding those returns.
So you brought up a point about the returns, and at the end of the day, this is a risk. Anytime you open up a business, invest into somebody that's not you, you're taking a risk on them, and it's the risk of the market, the business, the opportunity. Everything's a risk. There's risk associated with that. And then we do different investments where we know we can get a certain amount of return. So let's talk about that. Let's get into a little bit of the weeds of that, because over the past probably year and a half, you and I have been actively investing in a number of different opportunities. But I would say the rate of return that Scott and I can go put our money into that's not very risky and get a return on it of an internal rate of return of somewhere between 15 to 25% IRR, internal rate of return. In other words, if you have an investment, you put $100,000 into an investment, and in 2 years, you're not making anything on every month, but 2 years later, you get 30% of that back. So you're on $100,000, you're getting $30,000. That's a 15% IRR over 2 years. If I did my math right, which I'm not always known for doing, right? So I try to use very simple, well-rounded numbers for things like that. But that's a typical rate of return. What I like even more than internal rate of returns, I like cash flow. Like, how quickly can we start cash flowing and getting a return on our money? Some of the favorite investments that Scott and I have done together and separately, we've started LLCs to do an investment together, purely passive, and we have separate LLCs and investment structures that we've done separate investments on. But the ones that are pretty much my standard is a 20% rate of return a year. Like, getting paid put $100,000 in, you're getting $2,000 a month, whatever those numbers are, but you're getting 20%. If it was 10 months, I think it would be that. But you're getting $20,000 broken up over 12 months. So I like investments like that. So when I think about investing money into a business, it needs to do better than that. If I'm going to put $100,000 into a business, it needs to do better than $20,000 back to me as a passive investor. So if someone asks a question like, what does the structure look like? And that depends on the business. But Scott, before we get into the Facebook questions, which are coming up next, any thoughts on as you look at that, like why would you choose to invest $100,000 into a passive franchise investment versus some of these others where you are completely hands off, might be able to add value to, but you don't need to if you don't want to?
Right. Well, I mean, number one is trying to beat that return. You know, you want that return to be larger. Number two, and something we'll probably get into more, is you might be able to structure the deal to which you can get your money back quicker. If the business is successful, one thing that that I've learned from Justin Donald, who's a great mentor, is really getting your money out quicker, right? So if you can structure the deal to where the business is loaning money to the operator, as the business grows, that money's getting repaid back at a quicker rate. Once you get your money out, then everything is just an infinite return. So that's one thing I like about that, is if it's a successful cash flowing business, you can structure it on the front end to get that return, or to get that principal out of that business right away.
100%. 100%. So what are you drinking, by the way? You got this out of the green room refrigerator, which is behind the weights, behind the TV, behind the mountain bikes, behind some garbage, next to a tool thingy.
Yeah.
So what'd you get out of the green screeny thingy?
Little LaCroix hibiscus. So
they're probably eventually going to be a major sponsor of the Franchise Secrets podcast, along with Highball Energy that gives me enough energy with no sugar. So let's get into some of the Facebook questions. So I posted this into the Franchise Secrets Facebook group, which, by the way, if you're not in the Franchise Secrets Facebook group, get in there. What's it? franchisesecretsgroup.com. franchisesecretsgroup.com, and you'll be able to join the Franchise Secrets Facebook group. It's a growing community, and a lot of people are helping each other out in there. Some really good questions, and some really experienced franchisees and franchisors are in there helping you out. And so I love community like that. It's not a place for pitches. It's not a place to try to get business or to grow this or grow that. It's a place to ask questions that you feel comfortable asking and get answers. So if you're not in the Franchise Secrets Facebook group, go ahead and jump in it. But let's go in there, and we've got some questions that came up in that group. The first one, as I'm looking, is Jesse Hudson. This might be in the personal page, but might be on the Facebook group. But he says, how do distributions work? First, payout on the profits. Like, is that the first one? And what about a structure with a salaried operator as a passive investor? So passive investor, salaried operator, and then what does that structure look like? Scott, you want to start with that one? Again, we're ahead of most of everyone listening to this podcast, but we do not have a successful track record doing this yet. But we are giving you behind the scenes what we're doing. So I hope it helps. Go ahead, Scott.
Yeah. So I mean, this is a good case that we were talking about earlier. I think to that question, because we have an operator who we're trying to basically have wind down his current business. So he's a business owner of his own, but he's looking at eventually getting out of what he's doing just because it's a little bit more labor intensive. He wants to find something a little more long term. So what we are actively working on is exactly that, is how do we make sure that he's paid enough up front to live, pay the bills, provide for his family, get our return back so that we can, again, get our principal out. And then once that's done, how does that structure look long term? So once we have our money out, maybe that equity amount changes.
Yep.
Because, but we want it to be a risk-free investment for him, because for him to give up what he's doing now, he needs a certain amount of income to live. So So it doesn't necessarily answer the question, but that is one of the challenges that we're working on right now. So maybe you have thoughts on that, Eric.
Yeah, I think very similar to what you were saying, Scott. I think we all want to de-risk as much as possible, as quickly as possible. So you made a point. This active operator is not a loser. I mean, so don't go he has a legit reason of why he wants to do something different. And I think that's really important. So he's a winner.
Yeah.
And and because he's a winner, he's like, I don't want to be doing the thing that I'm doing now 10 years from now because it's going to wreck my body. That's his mindset. So he's like, I'm successful with this, but I'm smart enough to know in the future I don't want to be doing this. It's not because I'm bad at it or because of whatever. He's really good at it, but he's looking at the future. So I really, really like that. He's a winner, and you need to have somebody that's a winner when you're going to partner with them, or they're going to be that active owner. So I think a lot of it's just that real open communication to say there does have to be de-risking on all sides. He needs to, from his perspective, I need to get Scott and Eric, and he's going to have a chunk of change in that too, but I need to get the loan paid back as soon as possible. That's got to be his mindset, and that's what he's got to be working towards. What we're doing as the investor, we need to be thinking, we don't want him to just be eating beans and rice for too long. A little bit's okay,
right,
but not for too long. But he needs to have that mindset to be able to pay us back. But we need to be able to give him a certain salary to be able to do that. And here's the deal. On the call today that we had, that was the topic of conversation. Hey, we need to make sure that this business is going to be able to provide enough for you and for us as investors. What do you need, and what does that look like? Because either it's jump all in, take a long time of a transition, or a shorter transition time so you can continue doing what you're doing and then transition out of that once the business is giving you as much or more than what you're making now doing the thing that you don't want to be doing 10 years from now.
So one thing that I will say that I think is really important, and that I've learned from Eric, because Eric is good at asking the direct questions. So when you're having these conversations, especially with people that are friends, people that you've known, it's really difficult to get into those topics of, okay, how much money do you make? How much money do you need to live? How much money, what are we talking here? It's so easy to skirt around those things, but it just creates problems later down the road because we don't have the expectations. So one thing that Eric's really good at is asking, you know what, you need to let us know, what are those minimums? What do we need to make work? So that everything is up front, everything is out in the open. We want this individual to give a little bit too. We're not saying we're going to give you a salary that's equal to what you're making in your current business now. He's going to have to believe that the upside is far greater. We're giving, he's going to have to give. But like Eric said, he needs to live as well.
Let's do some coaching here. Scott said, Eric, I am pretty good at that. What you do is you just say the hard things with a smile. That's all you do. But Scott's like, you need to tell us this. We need to know this. That's not what you do, Scott. That's why you're not good at this. You say it the wrong way. No, but what Scott's saying is that's what we do need to know. That's our mindset. We need to know that because we need to know that. You don't ask it like that, and Scott didn't and wouldn't ask it like that, but this is how you ask those types of questions. Hey, so, we want to make sure that expectations are being met all the way around. And we know you, just like us, have minimums that we need to make every month or a year from a budget standpoint to be able to survive and to put food on the table for the family and just have our current lifestyle. Because mine's not extravagant. His is. He was in Hawaii for 2 weeks before he came, but mine's not extravagant. Chris's is not extravagant. We'll leave Scott as an outlier in South Dakota for now. Right. But the point is, if they don't have an extravagant lifestyle, you find out what that number is, and then you work back into that. And so you ask them in a way like, hey, we're wanting to make sure expectations are being met all the way around. What would be helpful at some point is if you would let us know kind of what that monthly or yearly nut is that you need to cover, because it's always different for everybody, and I don't want to have the wrong expectations going into it. So, if you're comfortable sharing that now, let's just talk about it. Right. If you want to come back to us later and after you think about it, let us know. That way, you've given them the opportunity to share it with you right there. Or if they're just not comfortable with it, or they don't know, then they're like, yeah, let me come back to you on that, Eric. And that way it's not an awkward thing. So you just give them you give them the easy way out, or you give them the avenue just to come in and say it.
But I think it's also important to note that, we want them to maybe give a little bit too, because the upside is going to come, like the greater upside is going to come once we've been paid back our principal, right? And so there's got to be that reward of needing to pay that back as quick as possible, instead of, okay, we'll match what you're currently making. Then is there the urgency to get that paid back? So just those are the types of things that I'm thinking about when we're having these discussions. Not sure where it's going to fall, but
we don't know. And like I said, we've been working on this for a while. Was really originally going to be the operating partner, but now he's going to be the owner, and we will have voting rights. Is another important part. We will have voting rights, so he can't outvote us. It'll be a unanimous decision. So even if we are a minority partner, we are not going to get outvoted on something as the investing partner in that. And so I think that's an important piece. Do what you want out there, because that may be important to you. It may not be, but for us, that's important that we have control of the business, even though, and with him, we want control, equal control, but we don't need to have control of the day-to-day of the business because it's their business. Another question. So that was a good question from Jesse Hudson. Shout out to Jesse with Exercise Coach. He and his wife are awesome people. They've been a part of the Franchise Tribe Mastermind, and they're active in the Facebook group. Great people. So Terry O'Donnell, who's another friend who's been out here to South Dakota. We got to visit on my porch last summer, but she's an experienced franchise consultant. Great lady, Terry O'Donnell. But she has a lot of questions. Oh my gosh, Terry, I didn't realize that you were going to have a list of questions, but I'm going to go through the list. Scott, pick out your favorite one. And so, is the salary repaid on a sale or an exit? What does the buy-sell look like if one of the partners wants to exit? Predefined exit strategy and a timeline to build ownership, 10% annually. So do you want to take any of those, or do you want me to take it first? And I just did to you, so you could easily toss it back to me.
Right. I mean, Terry, don't ask questions that we don't already know. So, Go ahead. Eric.
All right. So what Scott just says, he doesn't have a clue on how to answer that, so he did kick it back to me in a very nice way. And I told him that we would do this to get him to commit, being my sidekick next to me, but he's more than a sidekick. He's delivering really good value. So to be a future regular with me, I wanted him to feel comfortable just doing this stuff. So is the salary repaid on exit? No, the salary is not repaid. That is their salary. And because the business is going to have some type of leadership and some type of like operational manager, somebody's going to have to lead that business at some point. So this is their business. More than like the salary being repaid, what we're looking for is a return on our investment. So a minimum of 20% return on our investment annually. So that's what we're looking for. And that's cash on cash. That is not putting $10,000 in, getting a loan, that is cash on cash. Put $100,000 in. My goal is to get 20%, $20,000 a year, every year, at least that for the life of the business. Would you say that?
I think so. And those of you that have been in sales organizations in the past, another way to do it is basically the salary that is provided is fronted and then eventually paid back through future commissions. And so that's another way to do it. I don't know if this is the right situation there, but to make sure that person is getting that minimum living wage or whatever you would call it. That just basically accumulates, but then as commissions grow, that just ends up being repaid through the business. So, there's a lot of ways to do that, but no, we would just be committing a salary.
Before I get to more questions, I want to bring another framework for people to consider, because I think it's important as you start looking at something from one perspective. You don't have anything to compare it against. Even just looking at franchises, you need to look at multiple brands to be able to know this is a good one that you're looking at or not. So you need to compare things. So if I'm you, I would start to talk to other people that are passive investors, not equity investors, but like true passive investors in other businesses, to see what's worked and what hasn't worked. And more importantly, why. Because the why is a really important thing, because if that doesn't fit with the similar type structure that you have, or the reasons or the purposes behind it, then it's probably not going to be advice that you want to take. You'll just stack it away as like, this is another way to do it. So here's something to compare it against. I can take $100,000 of my cash, put that into a restaurant franchise or mom and pop. There's a group that I work with that I could take $100,000 to. They will open up location number 1 for me. They own 70% of it. I own 30% of it. 100% of my money, 30% equity is mine. So think about it that way. That is a structure, and I'll tell you what, people that have invested into this structure are extremely happy. And the reason is because it's a proven operating group. Deep capital, CFO, CMO, district managers, everything's built out, proven track record in the QSR space. So they go in with a team of experts that you would not be able to hire yourself. You don't have the experience yourself, but that's their structure. And I saw some of the returns that the investors were getting at a 30% investment return on a 30% equity stake in that business. And it's crazy. They're happy. And how do I know they're happy? Because they're coming back to do number 2 and 3 and 4. So simple structure. You put up 100% of the money and you get 30% of the business. That is one structure out there that I've seen. But again, proven operator, great track record. And so again, just use that for comparison purposes. And if you're ever interested in like doing something like that, just reach out to me, because I'm putting together a group to do investments like that. But you'll be able to see their track record and see if you want to do it yourself. But going back to this, where we are not doing it with a big group, we are doing it with ourselves. The question number 2 from our friend Terry is, what does the buy-sell look like if one of the partners wants to exit? Here's it simply. I think it's the buy-sell it's always tricky. Always, I said it was simple, and then I say it's tricky. It's simple once you have a cash flowing business that's at its peak. It's really simple because there's comparisons, there's discounted cash flows, there's multiples. It's really easy to do. The challenge is when you are first getting started, when the business is at the point where it's about ready to start generating cash flow, or it's going to generate a lot more cash flow in the next 6 to 12 months. So that's the tricky part to value a business. So buy, sell, business valuation gets tricky. That's where you really just need to there's not a really good answer on that in that awkward transition state of a healthy business. With that, I'd say you just need to come to an agreement. The best thing that I've seen is partners come together, 2 partners. Hey, Scott, if you want to buy this business, you give me a price. If I want to buy it from you, I'll give you the price. Here are the prices, and then you do it like that. I can't remember what it's called, like a shotgun or something like that. I'm sure shotgun is not the right terminology. It's like a bull in a right. Not a china shop, bull in something, bull in a rodeo. Go ahead.
Well, I was just gonna say, that's kind of goes back to like the equity amount and everything else. The structure you were talking about with the large group. If they're getting 30% or giving 30%, doing it the way we're doing it, there are all of those things that we need to think about, because you have a little bit more risk this way, a little bit more work this way, because if one of the partners or if the operating partner decides to leave, we're the ones that are going to have to replace that operating partner. So, those are the things to think about too. Probably a little bit more equity is going to need to be retained, because even though the goal is passive investment, there's still a business to run. And so if you lose that operating partner, somebody has to fill that void. So, but yeah, buy sells or the buy sell or the exit, that's really difficult.
Yeah.
In these small businesses.
Okay, let's continue on to a lot of people are just giving good feedback. Like, keep doing this. Justin Sloan's like, much like real estate, there's so many ways to structure partnerships and franchising. Continue shedding light on this, as all people should have franchise cash flow in their portfolio in some way. Justin, that is so true. Like, if you're wanting to get into business, get into partnerships, franchising is such a great way to do that. So I love that comment. It's Ryan Casey, our friend Ryan Casey, who is a killer sales coach. He's got so many things that he's helping our team out right now. I've seen him help great Massage Envy franchisees, Amazing Lash franchisees, help them with their businesses and sales. And when I say help them, I mean, they go back and they look back month over month and like, holy cow, before Ryan Casey, after Ryan Casey, Ryan just did a tremendous amount gave him insight and help to make significant fundamental changes in their sales process, which resulted in massive increase of revenue. Go figure. But Ryan Casey's active in the Franchise Secrets Facebook group, so just tag him if you have any sales type related things going on. But Ryan's question, I had to give Ryan a shout out. He's in the mastermind. He's going to be here. I think he's going to be here well, you know what? We just called this on the way up. I'm getting distracted here. But Caleb and I were bringing in all the fancy lights for the studio out of the basement. And I said, you know what we need to call this thing that we're doing in South Dakota? We called it you're not supposed to cough on podcasts, first of all. But we called it the Black Hills Meetup because I wanted a really low-key name for hosting franchisees and investors out here at my house and around the Black Hills. So we called it the Black Hills Meetup. I said, dude, I just had the greatest idea. Let's call it the South Dakota Shindig. So I think it's going to be the South Dakota Shindig. That's the new name of it. I believe Ryan's going to be out here. But his question, back to the question, is would love to get as many details on the operating agreement as possible. Maybe the 5 to 10, geez, Ryan, 5 to 10 essential parts of the operating agreement for scenarios like this. So I think number one, like we talked about just a little bit earlier, is a lot of it's going to be, there's probably 5 to 10 areas where your attorney is going to come to you and say, do you want this to be majority, supermajority, or unanimous? So whenever you're going through an operating agreement, you got those three things, majority, supermajority, or unanimous. And that is the structure for making decisions for the business entity. As the passive investor that doesn't want this business to go rogue, I want to have unanimous on about everything. So what that does is it gives me control in the business, and it doesn't let them do whatever they want if they decide to go rogue, because especially in the beginning, it's my money that's invested into this whole thing. So that's an important piece. Definitely when it comes to selling the business, when it comes to what kind of distributions you can make, when it comes to being able to just like their change in the business, the amount of effort that they're giving to the business, they can't just make that decision themselves. Like, hey, I'm going to increase my salary from $10,000 a month to $20,000 a month, and I'm going to work half as much. You don't want that. You don't want to lose control of that type of scenario within the operating agreement. So those are, that one thing will impact 5 to 10 different areas of the operating agreement. And here's the other thing with operating agreements, you've got to think like this. You've got to run these scenarios through your head, even though you don't want to. What happens if my partner dies? Guys, this happened to me. I think I've told this before, but I had a partnership that passed away in a tragic accident. I never saw it coming, and it did have an impact on the partnership. So you need to think about those things. You need to think like, what happens if there is a divorce in the partnership? What happens at that point? There needs to be triggers in there to be able to accurately do what you intend to do. So those are some operating agreement, kind of thoughts that I have. Do you have anything on operating agreements, or should we go on to the next one?
Yeah, no, keep going. I think you hit on it.
Okay. So I'm losing track of all the different ones that we have. I think we are done with questions. So here's where we are. We are in conversations with the franchisor and the owner that we are investing in. And I wanted him to take full control of the conversation. So in the past, he's leaned on Scott and I because we're the experts. We've done this before. This is the first time that we said, Chris, it's you. You're getting on the call with the franchisor. You're leading this thing because we are the passive investors. And you did a great job with it. So we are early stages with this. I expect it to move pretty quickly, one way or the other. Either, a month from now, we'll be like, this is what we did. And we'll come back on and share the things that we've learned along the way. But as with everything, I like to be really open, honest, and authentic with the audience here. The things that I have a tremendous amount of experience with, which is helping franchisors and helping franchisees. But this structure of a passive investor to an active owner is brand new for me. So Scott, any last bits of wisdom that you would want to just thoughts or probably not wisdom. That's a tall order. But anything that you want to share with the audience as you've thought about it over the past 2 hours since you knew you were coming on.
No. I think this was fun. This was really fun. I think it would be fun to see an update as we go. Even in the operating agreement, like Ryan's questions, we might be able to lay out kind of what we are doing, what we're discovering during the process. And so I like that. I like this. Thanks for having me. It's been fun and just learning this process. I think the biggest thing for me anyway is going to be the learning transition from being more of an active owner to a passive owner. That's one of probably the biggest hurdles to overcome. So that journey is going to be a fun one to kind of see. Because
we're going to be able to do more. My last parting comment will be, as a passive investor, we will be able to have impact on the business, but it's not going to be impact because we're working hard in it and we're very active in it. I don't even want to be running meetings, weekly meetings in the business, because that's what I've done as an equity partner in the business. I've run meetings like that every week, but I don't want to do that anymore. I want them to run the business. It's their business. I think about this like as an area developer. I've been an area developer with 3 different brands, and I would bring on franchisees, I would coach them. Now the franchisor coaches them, but now I'm able to be a sounding board when they are ready to make major decisions. And if I'm, through my network, through some things that I'm involved with, can have a significant impact on that business, maybe it's making a couple phone calls to make some introductions to be able to get some business, I want to do that. I want to do that type of thing in the business, but I don't want to be an active owner anymore. Scott, sound good?
Sounds great. Thanks again.
Yeah, thanks for coming on. Don't forget to join the Franchise Secrets Facebook group, franchisesecretsgroup.com, and we're getting a lot more active on YouTube. This will be broken down into bite-sized chunks. So get on YouTube at franchisesecrets.com/YouTube, and it will take you there. Be sure to subscribe and enjoy the content. Thank you.
Thanks for listening to this episode of the Franchise Secrets Podcast. Whether you're watching or listening, please make sure to subscribe to my YouTube channel and to whatever channel you're listening on. If you want my help with anything from buying a franchise to franchising your business, please visit franchisesecrets.com.